and thanks for watching. I'm working today more on my stock market stuff, so I have a project. I'm going to eventually have an automated uh, computer code system, which will give me longs and shorts for each day, and it should reliably return money. So, before I get started, let me go over the outline for the model. I'll explain where I'm at, explain what I've done recently, and then I'll talk about what I'm going to be doing today. If you're interested in the stock market, coding, AI coding, uh, any sort of market in general, you should subscribe and follow along because I work on this every day, and every day I'm gradually improving the model so it works a little bit better, and I'm a little bit closer to going live with it. So, this is my first goal: is beat the S&P 500 by a significant margin while staying market neutral. So the S&P on average goes up 6% per year. I want to do 3 to 4 times better than that, and get 18 to 24% per year. With the caveat that I want to be market neutral. So I want to be immune to, you know, sudden rallies or recessions. No matter what, I want to be returning 18 to 24% every year reliably. So at the bottom is the outline for the strategy. So I have data going back to 2011. I don't want to use everything. I just want to use things that have similar price dynamics, things that have high volume, and things that aren't penny stocks. Um, my mom's calling, but I just started my stream. Hi, Mom. I'll call you back after. What's up in your world? Um, yeah, so personally, the universe I'm using is real estate investment trusts, ADRs, which are foreign companies listed on the US market, and common stocks, things like Apple and Tesla. I'm dropping out everything that's under $5 a share, trimming down to the top 2,000 by volume, dollar volume, and then dropping out anything that's had a 50% crash in the last year. Um, and so that's my universe of stocks. I've found that I have pretty good success on that. And I'm able to train a returns model with the 5 day forward sharp as a target. So this could be anything really, but you want to predict returns, returns relative to the market, returns relative to sector, probability of a positive return, log return, something like that. Or you could predict the Sharpe ratio. So I've gotten pretty good success predicting the 5 day forward Sharpe ratio. Um, and then I'll go over why I think the model's good in a second here. Um, but once I have a good model going, the last step is to make some portfolio strategy for it. So take the outputs, take the predictions up from the model. I should be confident independently in these predictions. And then given the model's predictions and some other macro parameters or monitoring parameters of the model, um, size a portfolio strategy accordingly. So that's really what I'm working on. They kind of go together though. I have a good model, but I'm fine tuning the model, trying to see if. So basically, I could change around how things are handled in the portfolio, or change around the base model, and I'm just tweaking these things, trying to squeeze the best performance out, while making sure that I'm avoiding overfitting. So it's kind of a balance between those two things. So here's the model that I have. I actually got this about a month ago, but I'm working on close to the same model, and this was the first successful model. So this is just for a single model, trained from 2010 to about 2019, validated. That means the hyperparameters are being tuned 2019 till about 2022, and then it's being tested from mid 23 through the beginning of 26. So first off, the first reason I think it's good is because of these metrics. So the top metric in the red box is the information coefficient. That's giving me the predictive power of the model. The next four metrics are giving me the stability of the model. Now, if you look at where these are in comparison to my goals, my goal for information coefficient is 0.01 to 0.02. I'm getting 0.047, so much higher. Standard deviation of the information coefficient, again, for the stability of the model, should be 3 to 13 times the information coefficient. It's about 3 times here, so at the lower end of the range. The information coefficient to information ratio should be 0.03 on a daily basis. I'm getting 0.3 on a daily basis, so it's larger by an order of magnitude. Similarly, on an annual basis, my goal is 0.3 and I'm getting 2.3, so again, larger by about an order of magnitude. And finally, T statistic, my goal is 1.98. I'm getting about 3.8, so about 2 times higher. So it looks really good for all the metrics. Now, if you look at the decile analysis, group it by deciles and then, or bin it by deciles and then show the returns as a bar chart. You see, this is exactly what I'm looking for. It's exactly what a good decile analysis should look like. The bottom decile should be the lowest, worst performing. Top decile should be the highest, best performing. And it should be monotonically increasing, which means each decile is higher than the previous decile. So not only am I meeting my threshold on all of these statistics, the decile analysis looks really good. And so this is just for a single model. So I'm left kind of with the question of, would this have performed robustly over time if I was constantly updating the training of this model? So that's what I did here. I did a walk forward analysis, basically to test exactly this question. And I find that the information coefficient is above my goal every single year. And the information coefficient to information ratio on an annual basis is well above my goal every single year as well. So I concluded this was good, and I decided to go ahead with this. I found something very interesting when I started implementing portfolio strategies on this model. So this is on the single model, which is tested from mid-23 through the beginning of 26. And it was really easy. Hey, good morning, Singh. How are you? It was really easy to get a successful portfolio strategy. Almost anything I tried, I got this nice increasing portfolio. There were drawdowns, but they weren't too extreme. And the average annual return, 40%. Obviously, that's very good. However, I did the same exact model on the walk forward results going back to 2016. And you see it basically went negative from 2016 through the end of 2021. So this is not something I could have implemented in live trading. Obviously, I wouldn't have sat there and eaten negative returns for 5 years, hoping the model would turn around. And so I would really like something that does well on the hold time range, positive 2016 through end of 2021, and then it just remains positive. It should look like this chart, this returns chart, the whole time, not just at later times. So I found out that the inverse is true. So here I'm showing if it does well at later times, it does poorly on early times. So I said, okay, let me optimize to early times. So this is optimized from the beginning of 2016 through mid-2018. And you can see it does well in that region, but then it fails afterwards. So the problem with this model that I had is basically if it does well at early times, it does poorly on later times. If it does well on later times, it does poorly on early times. So I looked at the model itself, and you see something I was a little concerned about is the decile analysis looked really good for the single model, but it's not strictly monotonically increasing for every single year. Secondly, the spread is changing value every year. So some years like 2020, if you look at the spread is from minus 0.06 to positive 0.02. Conversely, if you look at 2021, there's a big spread. It goes from minus 0.2 to positive 0.15. So that's quite a bit larger. On the positive side, it's larger by almost an order of magnitude. And so the bigger the spread is, if I'm doing a long-short strategy, the better it's going to do. So I then tried, so I made a new model. So here are the results, the first results with that new model. So I tried changing the number of validation years. More validation years is basically more robust. So I'm sacrificing some training years to the validation years, which are tuning the hyperparameters of the model. And then down here I tried this, where is it? This model I trained. And so this actually showed a good improvement. Um, and so I kept only the important features from the previous model I was showing. So I trimmed out everything that had a coefficient of variation above 1 and a mean importance below 0.05. Um, and so if I left those features out and then kept only these important features, you see the performance is actually a lot better, and it does well from 2016 through about 2020. It's giving maybe 40% returns, and then it does crash down from about March 2020 to about January of 2021. But then it goes positive again. So this is a much better problem to have instead of this binary regime problem where it does well on the later years, poorly on the early years, or well on the early years, poorly on the later years. Now I have something that's doing good over the whole time period, but fails during the COVID recovery. And the COVID recovery is a pretty interesting thing. There were basically a lot of retail investors with lots of cash to throw around from stimulus checks. And that made the market hard to predict. And it's also a fairly unique event in the span of things. When again is the whole economy going to shut down, and then 1.5 trillion dollars will come out of thin air to be invested in the market. That's kind of a unique event. Although that is exactly how things were handled in 2010, just a lot more cautiously with COVID. So I tried some different things to improve the portfolio. Um, and I also tried a better model here. So earlier, before I was using Sharpe ratio as my target, when I was using log returns as my target, I found that adding in, keeping all the features that I had previously. Hey, global. I found that keeping all the features I had previously, but then adding in mean reversion and volatility features neutralized to sector instead of the market. Well, keeping the ones neutralized to the market, I added in new ones neutralized to just the sector. And previously that improved performance. So I tried that here at top, is just with those new features added in and keeping all of the features. And this is the performance here. So actually it doesn't go negative during COVID. So that seems really good. Um, and then I trained the bottom model here, which is same thing as before. I'm keeping only the important features. So dropping out everything with a mean importance below 0.05 and everything with a coefficient of variation above 1. And this model actually performed worse. So what have I been focusing on recently? Um, Scaling by the spread and scaling by the information coefficient. Um, So I forgot what this. Oh, this is a 10-day model. So the top is the 5-day model, bottom is a 10-day model. The 10-day model actually performs. It seems like it's more volatile actually, because it does worse on the bad years and it does better on the good years. So that's kind of interesting. And then I've been working on the portfolio strategy. So this one didn't do well if I'm doing 20 longs and shorts, but I do have something that actually does look like it's doing well. So I'm going to have to dig into this. The problem is if it does well just picking 5 longs and shorts, I'm afraid that it's overfitting, and that's going to hurt the model stability. But you'll see that if I just do 5 longs and shorts, it never goes that negative. So what were we discussing here? Oh, right. So it wasn't plotting the daily scalars, though. So I want to see how is each scalar affecting things. So if has attribute scaling history. Oh. Right after the loop. Get the scaling history. Plot, print, run. 4, 4, 4, 4, 4. Where does the for loop start? If daily scalars. Okay, so this, I guess it's an if loop. So it's this block. Oh, let me find it. Okay, there we go. And here are the results. So it doesn't show the scaling history, but you can just look at this. So it still had a downturn during COVID, but it's not even hitting a 20% downturn. Did I put the drawdown? No. So this is basically with no drawdown threshold, but a very low target volatility. So it should be scaling down by volatility a fair amount, but not scaling based on information coefficient or the spread. And honestly, this looks pretty good. The one concern is that I only have 5 shorts and 5 longs. But if you look at first, let's look at 2016 through the beginning of 2020. So that looks good. Basically, I would have made it up to 60% returns, 66% returns before crashing in 2020. And so let's see what it would have crashed to. So here we would have crashed from 60% returns all the way down to here, about 37% returns. And that's over the course of almost a year, so about 10 months. But I think that's something maybe I could tolerate. And then by when was it recovered? So it recovered by here, mid 2021. And so what was the drawdown period? Whoa, max drawdown duration under a year. I don't think I've gotten that before. So worst drawdown was under a year. Okay, so that looks really good. Now, what if we just turn on? Okay, now we should get that. So let's use information coefficient scaling as well. Say when it drops below 0.001, lower exposure. Buddy. So let's see if that helps at all. So I don't really get what the issue here. Out of sample last 5 months, what does it say? The idea is that the world is changing extremely with AI bots. Um, yes, I have to look into that. But my idea is that will be kind of my final test. I'm going to get something that works well, and then the final test will be okay. So, because I only have data, I got the data, I think it was in January. So I only have data going back to January of this year. So once I get something that I feel like works well, I'm going to build the live implementation for it, and then I'm going to pull all data up to now and then see how does it run. I have to go to the bathroom really quick, so I'll be right back. Hey, Robert. Robert Kawasaki, isn't that a famous guy? Um, let's see if this works. Yeah, so I guess I want to see which scalars are dominating. Hey, Eric. Claude slash make dash money. What does that mean? Oh, there are the scaling coefficients. So let's see. Information coefficient goes high. Volatility scaling is dominating. Spread scaling doesn't have an effect. Active drawdown doesn't have an effect. Huh. That's kind of weird. I didn't expect it to look like that. Okay, so I think the volatility is dominating. Beta neutral long short scaling. Uh, HRP waiting with 60-day look back. Smooth predictions on. So let's see how this would have done. Climbed up to, again, 60% returns, dropped below 20% returns. Bigger loss here, which we see from that. Oh man, this plot looks really shitty. This configuration tells a coherent story, and most of what it's telling you is concerning. Let me walk through what each choice implies, then get to the robustness testing, which is the part that matters most before you trust any of this. Read together. You've turned off every signal quality and risk state filter and kept only the volatility scaler. You're running highly concentrated with lengthy holding via prediction smoothing and a wide rebalance buffer. The volatility target at 12% with 20-day look back is the only thing actively modulating exposure. This means your best strategy is one that ignores every single degradation warning. Okay, so let's fix the plot. Okay, so what if we increase this to 25 on each side? Um, Smooth predictions, but drop the buffer multiplier down. Keep beta neutral. Set target volatility to really high so it basically turns off. Turn off the drawdown. Only use IC scaling and spread scaling. She's got a way. Alright, so let's see how that does. What did I do? So no volatility scaling, only spread and information coefficient scaling. How does that perform? Conclusion 1, you're okay. So conclusion 2, safety overlays are not well calibrated to your signal. When IC scaling, spread scaling, and drawdown scaling all hurt performance, the most likely explanation is that their parameters are tuned for a different kind of strategy than what you're running. A concentrated 5-name strategy has totally different dynamics than a 50-name strategy. IC at small n is dominated by which specific names you picked, not by signal quality. Your IC scaler with its 20-day lookback and sigmoid threshold tuned to IC 0.02 is probably reacting to noise, and n equals 5. Okay. Prediction smoothing plus buffer 1.5 combination is doing the real work. This effectively lengthens your holding period and reduces turnover. Combined with n equals 5, this is a high conviction, slow rotation profile. That's a legitimate strategy archetype, but it also means your effective number of independent bets per year is small, much smaller than your daily rebalance cadence suggests. Okay. You have very few independent observations supporting this configuration. This is the one I'd weigh most heavily, with 10 names, smooth predictions, and a buffer that delays rotation. Your effective sample size for evaluating the strategy is much smaller than your daily count suggests. A 10-year backtest with daily P&L looks like 2,500 observations. Okay. Instead of picking top 5 in equal weighting or HRP weighting them, hold top 30 with weights proportional to signal rank. If concentration is real, the top names get more weight automatically. If concentration is artifact, you're diversified. So this should finish soon. Looks bad. 2,000-day drawdown duration. Rerun your Optuna optimization on data through 2020, then evaluate in 2021 to 25 with frozen parameters. This is taking forever to plot. Why is this not a... Why is this taking so long? So basically turned off volatility scaling, turned on IC scaling, turned on spread scaling. Is this stuck? Looks good to me. Realistic transaction cost rerun. Yeah, what is going on here? Where's it getting stuck? Is it stuck on plotting? Rerun your Optuna optimization on data through 2020. Through 2020. So let's see if we can see which drawdowns are dominating. So spread drawdown is dominating, I think. So both of those could probably be a little less intense. Okay, and then this down here, let's try. We need both of these to be a little less restrictive, so information coefficient look back. So if we do 20 days, let's just make it less restrictive, minus 0.01. All right, let's run that again. Okay, so for the optimization, we want to optimize smooth predictions, rebalance days, so I need the Okay, I have to go to the bathroom again. Yeah, that seems like it could be cool. I know, I always think that, but then it's so much work. By the way, I'm on stream. You're not on speaker, but I figure I'll let you know. Yeah, well, that's the problem that I was thinking about. Uh, Let me see. Probably not, because then I'll be down there, and then I won't. I'll probably. Uh, I don't want to spend the whole day down there. Okay, cool. Yeah, let me know, man. All right, talk to you later, man. See ya. So, I made things less restrictive, but that's not really helping. So let's put this guy in. Yo! No, that sounds fine. Oh, yeah, I do. Sorry. Well, it was $29 for the golf, but then I owe you $2. So $31. Can I Zelle you? Okay, cool, I'll do Zelle. Alright, see you, man. Okay, so that's going to take a long time to run. Let's see, is that using up resources? No? So I can do other stuff while I run that. So I'm trying the first strategy. Okay, so let's put in here. All right, so parameter value. Then let's do number of long shorts, um, hysteresis scaling, smoothing, number of long shorts, hysteresis scaling, smoothing. Let's go back here and look. Scaled HRP. So long shorts, rebalance days, HRP look back, smooth predictions, buffer multiplier, sizing method, volatility target, volatility look back. Okay, here are the results. Oh, this is back to the really good results. So up to 120% gain, down to, what is this, 67% gain. So back to this. This looks good, but I don't know. Those returns look kind of ridiculous. It would have doubled over 2025. I'm kind of dubious. Average annual return 32%. What's the drawdown duration? 297 days, so drawdown under a year again. So I don't really need all of this. I can just put in cumulative return and drawdown. Alright, so there's like at least that. And long short, rebalance days, HRP look back. Smooth predictions, buffer multiplier. Sizing method, target volatility. So we have 5 longs and shorts, 1 rebalance day. HRP look back is 60. Prediction smoothing is on. Buffer multiplier 1.5. Sizing method beta neutral. Target volatility 0.12. Volatility look back 20. IC scaling off. Spread scaling off. Okay, should I put anything else in here? Maybe I'll put this whole thing in. How's the optimization doing? Still on the first optimization. So this is going to take a really long time. Alright, so let's put another note in here. Okay, so the first concern is that I'm overfitting. The second concern is that so what if we take out volatility scaling and turn on information coefficient scaling and spread scaling? All right, so that's going to take a while to run. So next, does implementing IC scaling improve basic strat? All right, so let me put some what the fuck? All right, so no look back, no threshold. Okay, Sharpe ratio. Sharpe ratio 1.67. Max drawdown 26%. Drawdown duration 297 days. Average annual return 32.7. Okay, so that's all very good. Now let's start varying these parameters. So let's use IC scaling true, spread scaling false. So let's try looking back. I guess I'll do 10 days with a 0.01, minus 0.01 as the threshold. Okay, so let's run that. See how it does. So with look back of 10 and threshold of minus 0.01, how does it do? Where is this guy at? So it started a new optimization finally. What'd the first one take? That was maybe 15 minutes. So how many are we doing? 1, 2, 3, 4, 5, 6. So 6 optimizations, 15. Yeah, that's not going to finish by the end of the stream. That'll take like several hours. Okay, let's try a longer look back. So Wait a second. Oh, what was the target volatility? 0.12. Oh man. Okay. Let me turn that back off. And was this the target volatility I was using? Or did I have it turned on? So while there's 8 people watching, I'll take the opportunity to say please subscribe. I work on this every day. I'm slowly marching towards something that I can go live with. Once I get this portfolio model stuff figured out, the next step will be start paper trading. I'm going to do that for a month, and if it works well on a month of paper trading, I'm going to go live. So if you're interested in that, subscribe. You could also get the code I'm using to make all the models at the GitHub link in the description. You can define a universe and create a model in under 100 lines. So if you're interested in that, go check that out. Try downloading it or forking it. And if you find it useful, please leave a star on the repository. Watch the repository and follow me on GitHub. All that stuff helps raise my coding profile, helps me get coding jobs and freelance gigs. So I'm running this now with the target volatility at 1 to see, is this what I had here, or do I need to set the target volatility back to 0.12? I think it's a little bit cleaner if I just leave target volatility out, but yeah, we'll see if that makes sense. Yeah, so this is with the volatility turned off. So it actually does scale down from volatility once. So what if I just leave off the volatility scaling? What's this fall to? 1.46. Okay, so let's change that back to 0.12. And then I'm probably going to have to do the same thing. So your paper trading is your holdout test. What do you mean holdout test? Like making sure there's no look back? Yeah. But I haven't heard that term before, holdout test. Oh no, well I'm using holdout tests. I'm doing basically this process the whole way through training the model, and now I'm doing it on the portfolio strategy. And then the paper trading is basically just another validation before I go live. If I've missed something, there's a chance maybe I missed something in the code. So I don't want to go live and lose money for a month and then turn it off. So the paper trading's kind of the final test. So let's make sure we get the same shape as this. So it's really the volatility scalars doing the work here. Yeah. So this looks the same. So this is what we had. So now let's turn this guy back on. Turn spread scaling on. What do you mean? It's kind of only in a single regime until it's not. How? I mean, isn't paper trading the same exact thing as live trading? You're just not using real money. Otherwise, what's the difference? So maybe this will help our COVID drop we saw in the last one. Here you see it's a pretty big COVID spike, and using the lower volatility threshold smoothed that out a lot. So, yeah, I'm kind of hoping I won't get as big of a spike here. You see the drawdown duration is a lot longer here. Max drawdown is fairly, more severe. Even if you look at here, it's bigger by about 5%. Yeah, so let me get rid of this. Markets change over time. Yeah, well, I hope that doesn't happen with me, but it still might happen. But that's just part of it. You find a strategy you think is good, then it doesn't work, you throw it away. Probably most people, unless they're a professional quant, walk away at that point. My strategy is I think I could just keep hitting my head against that wall, keep trying, and something good will pop out. So this might be better. Longer drawdown duration. Draws down from 80% gains down to below 40%. So what is this? The beginning of 2021, it falls to 35% total over. Max turnover is worse. Average daily turnover, max return is worse. Max drawdown time is worse. So that didn't improve anything. All right, now let's change this window to 20. All right, so the sharp here, 1.49, so a little bit lower. Max drawdown, minus 28%. So bigger drawdown, worse sharp, bigger drawdown, longer duration. Average annual return, 27%. So worse on every metric when I'm doing a 10-day look back with minus 0.01 as the threshold. For sure, you can do 3 crashes or very volatile events before selecting it. You could find out sometimes that models perform in conditions. Some of them in some conditions did 10%, 3%. 10% is too much profit. 10% per what, year? Or, I mean, I hope not day. That would be crazy for day. Yeah, but 10% for what? What time period? Okay, so here's with a 20-day look back window. I'm really interested in this region. So it went up to 1.8, so higher, drop down to, what is that? 1.3, so not much higher. I think this will probably be worse. Alright, so we've got these. Let's, oh. Put it in, then I could run the next one while I'm documenting. Hey, Sir Night Night, how are you? The Quant King, our quant hero, who's got a successful strategy. Oh shit, I turned on spread scaling. I want IC scaling. Oh man. Alright, let me make sure I got the same results one more time. These might be the wrong results. Sir Knight passed prop challenge. Yes, indeed. I have to go to the bathroom really quick. I'll be right back. So if we go back to this guy turned off, let's see what did we get. So 297 days of drawdown, 1.67 sharp. That's the same thing I got, right? 290. Yep, 297 days. So let's take all of these guys out because that was with the wrong thing turned on. What is a prop challenge? Live trading challenge. It's like playing chess, but the game is making money in the market. So let's go back to here. Test scaled HRP. So that stuff I'm gonna leave all the same, but let's turn on IC scaling. And let's use a 10-day look back. We'll do 10 days, 20 days, and then 40 days. Then we'll see how does it do. Make sure everything's good. So spread scaling's off, IC scaling's on. 10-day look back minus 0.01 as the threshold. Oh, you passed. Your bot? Well, you're really riding the highs and lows, global. You'll either have a good model or a bad model at the end of the week. So while there's all these people here, I'll take the opportunity to say please subscribe. I work on this every day. And I'm slowly marching towards having something I can implement live. So if you're interested in that as a project, yeah, you should subscribe and like the stream. That stuff helps me out. Also, check out the GitHub. You can use the same code I'm using to build the models, define the universe, build a portfolio. That's all at the GitHub link in the description. If you find it useful, please leave a star on the repository, watch the repository, and or follow me on GitHub. That stuff helps me out. So let's see how we did with this. So seems worse. Sharp ratio is the same, slightly higher actually. Annual return is significantly lower. Drawdown duration is longer. Max drawdown is not as bad. So, I guess I'll take what I can get. Alright, so let's change this to be 20-day look back. Okay, so with 10-day look back, how did we do? Sharp, 1.67. Drawdown, 23%, so better. Drawdown duration, 376 days, so worse. Average annual return, 25.6, so worse, but, still good. They make most of their money on the fees paid to take. Prop firms create challenges to weed out what they think are bad, unprofitable strategies. And if you pass, then they pay you. Oh, yeah, that does sound shitty. They make most of their money on fees paid to take those challenges. If you're really good, then they invite you to trade real dollars. So I guess it's a way to get discovered. Let me look up prop challenges. Maybe that's how I could get discovered. My quant discovery. It's like being a star. It's like wanting to be a movie star. I've been discovered. Oh boy. Um. Oh, I need to change this. All right, so this is 20 now. Did that just run? Oh, it just ran right here. So that looks better, doesn't it? Can't really tell. I'd be happy to sacrifice these huge returns at later times if it meant COVID was good. So now COVID dropped again from about 120% down to 67%. So basically the same. Okay, so this is with look back 20. Let's do look back of 40 now and see how does it perform. Alright, so let's do look back 40 and let's run it. And let's keep this. So 20-day look back, once again 1.67, not much of a difference. Max drawdown now is 25%. Drawdown duration 418 days. Average annual return 25.25. So it seems like making this drawdown longer is basically lengthening the time that we recover from COVID. But when you figure out a solid and robust strategy, then you realize prop firms will kneecap a strategy quick. What does that mean, they'll kneecap it? They'll ruin it? They'll steal your strategy, or what? The purpose of a backtest is to discard bad models, not to improve them. Hey, that's a good quote. Alright, so here's 40. We dropped from 100% gain down to 40%. So it's getting worse as we're using a longer look back, at least at this threshold. Okay, so there's 40 days. So let's go back to 10 days and use a more intense cutoff. So minus 0.001. So 10 days with a stricter threshold. How does it do? Oh yeah, I'm sure they are. Well, any sort of thing like that where it's like a challenge, you can't really trust it because you always go, how are they making money? There's some way they're making money. I'm giving them something here. They're making money off me somehow. Did I run this? So it should be 10 days with the sharper penalty. Yep. Okay, so DePrado's quote on backtesting is generally misunderstood. I take that to mean basically your backtest it seems pretty straightforward. How's it misunderstood? That seems like it's saying the point of backtesting is to throw out things that don't work. You don't use backtesting to it seems like basically you build a model from first principles. And then backtesting is validation. If the backtest doesn't work, you need a better model. That's what I take it to mean. When a metric becomes a goal, it stops being useful as a metric. Yes, that's true too. But I don't know. There's always a trade-off. Everything has a double purpose. Well, that looks really good. A tighter, start penalizing it earlier. With a small look back. That seems like it did better. Yeah. Here it only fell down to 72% with a peak at 120%. So still bad, but definitely better. And that drawdown doesn't look too long. Oh shit. They're not shit. Alright, I need to run that again to screenshot it. But how does it look? So these values should be the same. Here are the values from before. So 1.55. Max drawdown, 26%. Drawdown duration, 400 days. Average annual return, 23%. OOS in multi-month for validation. Your goal should not be to build a model to pass back tests. Yes, I think that's exactly right. Backtesting is important and has its place. You do want to pass them, but context matters more than just shifting parameters, which is usually what happens, aka noise mining. So 10-day look back minus 0.001 is the threshold, right? Yeah. Here we go again. Okay, so the Sharp here, 1.69. So higher Sharp ratio. Max drawdown is about the same, 26%. Duration still 297 days. Average annual return is 26%. I'll put it this way, when I figured out the context to my strategy, I knew it would work regardless if I backtested it or not. The backtesting was just to fine-tune my execution in a meaningful way. The hard part was finding the context. So remind me, Sir Night Knight, what is the base model you're using for your strategy? You don't have to tell us about like the specifics, but I'm wondering it's a machine learning strategy, if I remember correctly. What's the here the core model is a gradient boosting method. What is your core model? Is it a machine learning model? So here we get the drawdown down to about 70% again. Okay, so let's try a 40-day look back with this threshold. Yeah, that is the hard part, is finding the context. So I tried to build a deterministic model that could identify informed traders at a micro level. I was able to identify them, but I had too many false positives to be meaningful. Um, yeah, so that's kind of into the granularity of the model. Um, so how many days was this? 40-day look back. So for 20-day look back, it should be these results. So 1.61. Yeah, so this is it. Minus 0.001. Sharp 1.61. Max drawdown 25.6. Drawdown duration 447 days. Average annual return 24%. Now, here's the results for 40-day look back. Same threshold. Sharp ratio 1.58. Max drawdown is lower, so 23%. Drawdown duration 408 days. Average annual return 23%. So maybe I want to use a bigger look back window. I think actually before that though, I'm just going to use this different threshold. I am a toxic trader. I trade with informed traders. I currently use inference to find them. That helped me reduce my false positives. What does that mean, a toxic trader? And increase my true positives meaningfully. That's what I need to do. Isolate. I guess you suggested that a while ago, Sir Night Night, is I should go through and look, what specifically is making the model failing, what specifically makes the model do well, and why. That's kind of the core to figuring this out. So if I change the threshold, 0.01, 10-day look back, let's see, how does that perform? So according to the trend, this should be the best performing. When I increased the information coefficient threshold earlier, it did better, and it's doing better at the lowest amount of days. So I'm hoping to see some nice performance boosts here, but we'll see what we get. Okay, so if we do 10-day look back, threshold of 0.01, how does it do? So that's going to be a stricter sort of thing. I guess it seems like it's doing better with stricter threshold, but also a shorter window, I guess, to catch that volatility in there. I'm not sure actually exactly why that would be. Okay, so we got some results here. Let's see how to do over 2020. So it went from 60% profit down to just above 20% profit. Yeah, I don't really know what to conclude about that. I got volunteers for the team captains. Now I have to get the players for the league. Congrats! Whoa, Sir Night Night, you only use logistic regression and random forest. Well, random forest isn't too different. The hard thing is interpreting what the random forest is doing, right? Because it's just all these trees with a bunch of rules. Or how many input variables do you use? Toxic trader is a liquidity taking entity who can. Oh, so of course, if you have some strategy, you don't like toxic traders who consistently profits at the expense of market makers, either through latency arbitrage or information arbitrage. So that's what happens in sports betting. Is if you're too good, you're taking money from the books, and then the books all collude to kill you. Not literally, but metaphorically. Yeah, so let's see. Let's run the next one. Should be 20, right? Okay, here we go. So now let's document these results. Alright, so here are the results. Let's put them down. 1.46, 1.47, really, we could say. .47, max drawdown 26.5, drawdown duration 465 days. Average annual return 24%. Okay. So here's with the same threshold and 20-day look back. How did it do over COVID? Dropped from about 60% profit to below 20%, 18%. In sports betting, it's different. There's literally no way to know the outcome of a match ahead of time without collusion from the team. Yeah, well, isn't that the same principle, though? It's impossible to know the outcome in the market ahead of time unless you have collusion with some market maker or something, right? How else could you know? I mean, even the best model, you never know anything. You have maybe a 60% hit rate if you have a really good model. Isn't it the same problem? Um, okay, so just for, this is getting worse every time, but just for consistency, let's do a 40-day look back. Now, is this optimization still running? Yeah. So I should, if I'm doing well, I should get a value of like 1. Um, okay, so 40, this should be saved. Make sure it's saved, and let's run it. Then let's document these. So Sharp is 1.42. Max drawdown 25.8. Drawdown duration 457 days. Average annual return 25%. You can have a sports betting scene from the chess league. What does that mean? A sports betting scene from the chess league? I'm not trying to make it out to be more than it is. You have people who are experts in commodities who are connected to deep pockets who will force price to new levels. Yeah, well, that's kind of the problem. But it's the same principle, right? I mean, they're just markets. You can't know the future of a market unless you have collusion. So the average return here is higher. Okay. Well, that looks really good, actually. What the hell? So the drawdown now is a lot lower. COVID doesn't look bad at all now. So it peaked here, it basically recovered to the peak. And then decayed till the beginning of 21, but it decayed from, what was it at? This looks, this is the best thing I've seen so far for COVID, at least. So it drops from 60% profit, 65%, what was it here? So high 60s to about 40%. Oh, that's really good. That's really good. This looks pretty good. Like when the tournament is going on, people can try and do some betting. That sounds like a legal nightmare, to be honest. I don't want to get involved with anything like that. That sounds like a total legal nightmare. Alright, so let's put the same thing in here. Ex-boss was pension manager. Oh, did try to do similar to what AlphaGo had for evolving. The secret is to predict next 4 candles. Wait, that's generally a secret for any time strategy, or? Secrets to predict next four candles. Ex-boss's pension manager used to move the markets for fun. Happens when you're the biggest in that country. That's crazy. No, they do it because they have a better sense of fair value than the retail market. Oh, um, they guide the market to where it should be based on their expertise. So you mean genuine experts who aren't manipulating? Dude literally moved the market because he could, even laughed about it. Limited by controls, of course. In order for them to do that, they have to absorb orders to the detriment of those impacted, but overall the market is able to continue. You can't have a market if fair value is allowed to go rampant. You can't have a market if fair value is allowed to go rampant. Isn't that the natural state of a market? Is the fair values moving all over the place? That seems like an indicator. If the fair value is moving all over the place, isn't that an indicator of a healthy market? Um, Even paid advocates for information arbitrage. When there is no real money involved, it can't be a legal issue. Yeah, I guess if you're betting points, if you're betting the points you have. But then people start converting that to money, it becomes a proxy for money. It sounds like a big nightmare. Look up AlphaGo from DeepMind. Um, well, how does it work? What's going on with it? So maybe I just need a stricter threshold and a longer look back window. You can't have a market if fair value goes hiding. Yes, that's true. The retail market is never in a position to determine fair value, not because of intelligence, but primarily because of timing. Can AlphaGo be used for trading? I thought, oh, it's AlphaGo is really like a model framework, right? Yeah, that I agree. It's all about timing. When can you get the information on fair value, and how well can you assess the fair value? Wow, so that gave. I improved the annual return and improved the drawdown. I didn't improve the drawdown duration significantly. So what if we try 60 days? 60-day look back window. How does this perform? And where is this guy at? 72% here, zero point 0.6. So that's 0.6 isn't a very good value. I really need above 1, especially on the optimized time. I want to learn from scratch what you're doing. Where can I start and what to learn first? Um, Start with just look and talk to the AI about making a quant strategy, automating a quant strategy, and it'll give you methods for that, and then just start exploring different methods. What are the different strategies I could build. You could build something for day trading, minute or second data. You could build something for swing trading, which is what I'm doing, 5 days, 10 days. You could build something for long-term investing. You could build, I'm doing a long-short strategy, so I want to be market neutral. You could do a long only strategy, a short only strategy, an options strategy. Really, it's about finding what data is available to you. If you want to spend money on data, find some data source for a strategy you think is attractive. If you don't want to spend money on data, you can kind of just copy what I'm doing. And you could even get the repository, like I always say, in under 100 lines of code. I'm defining a universe and creating a model. So you can start with the same thing I'm doing pretty easily. Um, yeah, so just looking around at different model frameworks, different model structures, um, and see how does it perform over time. So if I keep decreasing the or increasing the look back window, it seems like it's doing better over COVID. So now it's going from a high of what 80% return down to a 44% overall return. But if at the worst point I was still up 44%, that's actually a drawdown I could tolerate. The big thing I would like to do is get the drawdown period smaller. And actually, if you look at the drawdown magnitude, did I save this? Yeah. So the drawdown magnitude is more intense when I'm using a 60-day look back window. So that might have just been lucky parameters I got before. His buddy sold his algo for $30 million. His edge, farming retail traders. That seems to be a common theme, don't you think? Um, his algo won tournaments. It was much easier to farm retail traders 15 years ago than it is today. Yeah. Then you just needed faster internet access. They have tournaments where the top algos compete, and the winners are bought by Big Pharma. That's what you call it, Big Pharma. Um, so this is a 60-day look back, 40-day look back. Okay, so let's go up. Here's the 40-day look back. The threshold of 0.01. Sharp ratio 1.55. That's interesting. So it goes down and then it comes back up. Max drawdown 18%. Drawdown duration 440 days. So it's getting shorter. Average annual return 26%. Alright, so if IC look back is 60, sharp, or no, IC threshold 0.01, sharp ratio 1.57, annual return 27%. Oh, whoa. Drawdown duration 302 days. Oh, it's a shorter drawdown, but back to the higher magnitude. 25% drawdown. So it's actually better on every metric. So let's try 100 days. All right. So let's see how this does. I'll be right back. I have to go to the bathroom again. And I'm gonna go make some more decaf really quick. I guess I'll throw up the results before I go. So that's from the most recent portfolio strategy. I think it was using a 100-day look back window for the information coefficient scalar. You would think it's wrong to farm retail traders. There's definitely a negative connotation to it for sure, but you're guaranteed to lose in trading if you try and take from the firms. I mean, it's the classic question of what's morally right. Sometimes things are morally in a gray area and you can make some money from it. Is that moral to make money off of it? Um, and the fact is, other people are going to do the same thing. So if it's already happening, is it immoral? If it's going to happen no matter what, is it immoral? So here it dropped from 75% returns to 30% returns. Still not bad. I want a quicker turnaround. I want to mitigate the loss during COVID and then turn around more quickly. So using a 100-day window with the 0.01 threshold, I get a Sharp of 1.54, so a little bit lower. Max drawdown is 25.6, so roughly the same. Drawdown duration, 414 days. Average annual return, 27%. So it doesn't really hurt the return that much, but the drawdown duration, I don't think that's a ridge. I think it's a local noise peak. Yeah, it seems like everyone uses C++ when there's some safety or speed thing required. Okay, I'm going to go make some decaf really quick. Oh, no, I didn't document that last one, so I'm going to run it again so I can document it in the PowerPoint. Okay, let me go make some decaf. So the drawdown ratio is getting worse, but the Sharp isn't dropping too much. Um, Making the window longer basically gives less noise in this exposure chart. Um, yeah, I'm not sure. So let's put this in the PowerPoint. Python slow, Cython a little less slower, Rust now. Yeah, I like Python because I'm used to it and I'm comfortable with the code. I can go and change the code and be comfortable. C++, it would be a huge learning curve. All right, so what are the trends so far? Higher threshold seems to do better. Longer look back can mitigate the drawdown. And maybe, yeah, maybe I'll just do 160-day look back here and see how it does. It seems to mitigate some things if I'm using a longer look back window, but also the short look back window does better for some things. So I'm actually not sure which I should use. Year of inception to 2019 or 2018. Well, it would have the same exact performance. Yeah, well, it is. You can't ever eliminate bias, right? You just want to minimize it. Um, but what do you mean year of inception? You mean just for the portfolio level or for the base model itself? Because, well, either way, it just seems like I'm trimming out some data. Because if I change the year of inception to 2019, the chart would look the same. It would just, the point at which it starts at 1 would be different, but the shape would be the same. Um, and really, I want to make sure I'm doing well over that early region from 2016 onwards. Now, this is really weird. It seems like if I try to use a really long window, like, what was this window again? 160 days. First off, it does really smoothly on these early regions. Still gets up here, but then it falls down to yeah, so it's not that great over COVID. 160-day look back with a threshold of 0.01. I get a Sharp of 1.53. Max drawdown 25.3%. Drawdown duration 381 days. Average annual return still 27%. So, but it's making up for that in later times. So what if I just change it to a year? Wait, what looks really good? The plot I just showed? This one? It does look good. I'm just concerned with basically the COVID regime. Could I be sitting here at the beginning of 2021 with a 25% loss over the last 10 months? I think if that's what was happening, I think I might turn the model off and miss out on all the really good performance. 381 or 481? What do you mean? Wait, what's... Oh, the drawdown? The drawdown here is 481. I mean, that's a pretty long drawdown, right? So 252 days, 0.01. What do we get? Okay, so it seems like it's doing way better at later times the further I move that out. I don't know what to make of this, really. What's it do over COVID? So it goes from a high of 90% returns down to 40% returns. Yeah. Nothing significantly different for the COVID regime. $100, so here it's 160. Threshold though is positive. So let's try to change this to 0.02 and see, does this perform any better? 10 days. Oh, thanks, Sir Night Night. Good. So I'm going to go through, keep looking through the rest of this stuff, but that's it for now. I got to go eat some lunch. So thanks for watching. If you're interested in this, don't forget to subscribe, like the stream, check out the GitHub. You can get the code for yourself, train your own model, define your own universe, implement your own portfolio strategy in about 100 lines of code. So if you're interested in that, go to the GitHub. The link's in the description. Download it, fork it, try it out for yourself, and you could let me know in the Discord. That link's in the description too, how it goes, how I can improve it. And if you find the GitHub useful, of course, don't forget to star it, watch it, follow me on GitHub. Yes, HRP is smoothing it out well. Anyway, that's it for now. Have a good rest of your day. Adios. Thanks for watching. it, fork it, try it out for yourself, and you could let me know in the Discord. That